The question on everyone's mind since the beginning of 2020 has been, is a recession coming? And to that, I can answer with almost 100% certainty that the answer is yes. A recession is coming. But before you panic and start to call your relatives, I think you'll find that this news is not as dire as you were expecting when you clicked on the video. There are things that we can do as investors to properly protect ourselves and actually profit off of dips in the market. So stay tuned to learn about recessions and bear markets, and we'll also go over specific steps that investors can take to prepare for the upcoming recession and bear market. And of course, I want to add the disclaimer that this is not specific financial advice. Before making any investment decisions, make sure you do your own research, and if needed, make sure you talk to a certified financial advisor. And also, make sure you hit that subscribe button. It really helps out the channel, and I'd really appreciate it. Thanks. Before we talk about the actual approaching recession and how to prepare for it, let's first just discuss recessions in general. The definition of a recession is a period of temporary economic decline during which trade and industry activity are greatly reduced. And generally, this is usually measured as a decline in GDP for 2 consecutive quarters. So let's break that definition down. First, what is GDP? GDP stands for Gross Domestic Product, and put simply, GDP is composed of the total value of products and services that are available for sale on a market. So if we take a look at the US GDP, the US GDP is essentially measuring all of the goods and services that we are producing in a given amount of time. So if the total value of those goods and services declines for 2 consecutive quarters or 6 months, then we would normally be considered to be in a recession. It really just means that our economy is shrinking. And I think that definition actually differs a little bit from what most people view as a typical recession. Normally, when a recession is mentioned, people are thinking about the stock market. And that's because typically a recession will lead to a significant drop in the stock market. So it makes sense that most people associate the two. And that effect on the stock market is actually going to be what we focus on in this video, since that's what affects investors like us. So when we enter a recession, we also typically enter what is known as a bear market. A bear market is simply just a prolonged drop in investment prices. And it's generally accepted that we are in a bear market when a broad index falls by 20% or more. So if the S&P 500 fell by a value of 20%, then most people would consider us to be in a bear market. And the opposite of a bear market is a bull market, which means that stock investment prices are increasing, but that's for another video. In order to avoid a bear market, make sure you hit that subscribe button. I would greatly appreciate it. That's the last time I'll ask in this video. I appreciate it. So before we move on, I really want you to understand bear markets and how we can prepare for them. And the best way to do that is to go back and look at the history of the stock market. Studying bear markets is actually really reassuring for me because I can identify the patterns of the market and realize that they're not actually as doom and gloom as the media sometimes portrays them to be. Using data from Bloomberg, if we look back at April 1947 until today, there have been 14 bear markets, ranging in length from 1 month to 1.7 years. The worst of these bear markets resulted in a 51.9% drop to the S&P 500, with the least severe resulting in a 20.6% drop in the S&P 500. And you're not going to get much lower than that because remember, to even qualify to be a bear market, it has to be at least a 20% drop. So there have been other dips that have been less than that, but for bear markets specifically, those are the stats. While that data may seem daunting, the fact that the longest bear market only lasted 1.7 years is actually very reassuring. That may seem like a long period of time now, but really, in the grand scheme of things in your investing life, that's really not that long. And according to previous performance on the stock market, that means that even if you lost over half of your investments to a bear market, based on the historical trends, we can expect that to recover in just over 1.5 years. So while these bear markets often cause a major panic and prevent people from actually getting started with investing, these events are actually shorter term than people think. And on top of that, if we look at this graph from Investopedia, we can compare bear markets to bull markets. And more specifically, we can see how short bear markets are compared to bull markets. The bear markets on this graph are shown in yellow and the bull markets on this graph are shown in blue. And this graph shows us that not only are the bad times relatively short, but the good times of the bull market and increasing investment prices is long, much longer than a bad bear market. And when I think about it, I think this is why a lot of people are more scared of bear markets than they need to be. Since bull markets have an average length of just over 2.7 years, they last much longer, meaning that people don't experience bear markets as often, which leads them to forget how to actually handle them when they come up. And I think as the more time passes, it builds and builds in people's minds, and they just make it a bigger deal than it needs to be. So the reason I bring any of this up It's just important to remember historical trends because it allows us to better understand market downturns so that we can know what's going to happen and we can panic less. Okay, I hinted at this at the beginning of the video, and I'll finally answer the question is when is the next bear market or recession actually going to happen? Well, I'm sorry to disappoint you, but I don't know. And anyone that tells you that they do know is probably lying to you. Professional economists dedicate their livelihood to analyzing trends and trying to predict when these events are going to happen. And it's proven to be almost impossible. The market is so complex and there's so many variables that can throw off even the most sound projections. What I do know is that it's coming. I don't know if it's this year, I don't know if it's in 5 years, but if we look into the future 10 years, I would bet that we've probably experienced at least one bear market in that time frame. And that's okay. I hope everything that we've talked about up until this point has eased your mind and helps you realize that bear markets are really just a part of our normal economic cycle. In fact, many economists argue that recessions and bear markets are actually healthy every once in a while for a thriving economy. So the moral of the story is there's no reason to panic. In fact, the people who panic are the ones who actually get burned in the market downturn. So to help you prepare for the rest of this video, I'm going to talk about the things that you can do to actually prepare for a market downturn and actually profit off of it. All right, the first step you need to take is to have a 3 to 6 month emergency fund. And I know this advice is in pretty much every personal finance video, and I'm sure you're tired of hearing it. It's pretty obvious advice, but that's because it's so important. Recessions and bear markets can lead to a number of events that could result in you losing your income. And on top of that, your investments are temporarily going to decrease in value. Because of that, you need to be ready to weather the storm. You want to keep your investments where they're at so that they can have the time to recover, because if you cash out now, that's when you're going to suffer losses from the downturn. Remember, the only people that lose are the people that sell. So the worst thing that could happen to you in a bear market is you lose your job, you run out of cash, and then you have to start selling your investments to supplement your lifestyle. Again, this is not the time you want to be selling your stocks. And also, bear markets are the time to capitalize if possible. If you're able to, I don't want you to slow down your investing during a bear market. Now, if you lose your job, you may have to, and that's okay. Life happens. But the more you have the financial support to actually invest, the more likely you'll be able to take advantage of a bear market. So that's why I like having a fully funded emergency fund. All right, let's move on to the next way to prepare, which is to remain calm. The reason we looked at bear markets from a historical perspective is that when an actual bear market comes along, you'll hopefully just be able to relax. The last thing you want to do during a market downturn is panic and sell, which is what so many people end up doing. Most people who are pessimistic about the stock market have a story about a recession hitting or a bear market happening and them losing everything because of it. But these stories are often failing to include that the reason they even lost money in the first place is because they panicked and they sold all of their investments. The popular mantra is buy low, sell high, but it's funny because from what I've seen, the average investor doesn't actually do this. When the stock market is booming and reaching all-time highs, people get FOMO and they want to start investing so that they don't miss out. But once the market sees any sort of downturn or there's talk of a recession, people get spooked and they stop investing, or they haven't even started investing in the first place. And the truth is, I don't want you to do either. We're not trying to time the market here, but we'll get to that in the next part of the video. Right now, I just want to drive the point home that if a bear market happens, you need to remain calm, because the historical trends show us that things are actually going to recover in a relatively short amount of time. And that brings us to the next thing you can do to prepare, which is dollar cost averaging. Dollar cost averaging is a critical tool that investors will use to reduce their investing risk. And while it does have a fancy name, don't get too intimidated because dollar cost averaging is actually super simple. Dollar cost averaging really just means you're not trying to time the market. And you do this by investing smaller chunks on a regular interval instead of just throwing a big lump sum of money in the market all at once. And let's break this down using the graph on the screen. As a hypothetical scenario, let's say you have $5,000 you want to invest. What would be the worst time to invest this entire $5,000 sum? Well, it would be right here at the top of the market, because as soon as you put your money in, you would see the effects of a market downturn. Now, what would be the best time to invest that $5,000 as a one-time investment? Well, it would be right here at the bottom of the market, because as soon as you invested it, you would see the immediate returns of the following bull market. But here's the problem. Like we already talked about, the market is almost impossible to predict. So the people who wait for the bottom actually usually just keep waiting and they miss out on a bunch of gains. And the same goes for the people who are scared. They don't invest because they're worried about the next market downturn, and that usually leads to them never investing. And this is where dollar cost averaging comes in. If we go back to our scenario with the $5,000, instead of investing the entire sum all at once, we would instead use dollar cost averaging and invest it at different points on the graph. So we'd invest $1,000 here, 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 and here. That way, we're mitigating risk because we're only investing a portion at the top of the market, and we're also investing throughout the market downturn, taking advantage of it. The good news is that if you're already investing in your retirement, then you're probably already dollar cost averaging by default. Because if you have a percentage of your income that goes into your 401k, you're investing when you get your paycheck every 2 weeks, which means you're investing on a regular interval over time. So the odds are that most people are dollar cost averaging when they're investing because they're investing over time, unless they come across just like a huge lump sum of money that they need to invest. The important thing is that you worry less about the trends of the market and instead focus on investing a smaller amount on a regular basis, because over time, the short-term trends won't matter anyway. All right, the last thing we're going to talk about is diversification, which is another critical way that you can reduce your risk in the event of a market downturn. Diversification means that instead of putting all your money in one stock or one industry or even one country, you instead spread your investments across many different industries and many different countries. And that's because sometimes recessions and bear markets can hit certain industries or locations a lot harder than others. So if you had too much of your money invested in technology and there was something that happened that caused a major downturn in the tech sector, your portfolio is going to get rocked pretty hard. But if you had instead invested that across a lot of different industries, a smaller portion would have been impacted, meaning that your losses would have been a lot less. And I mentioned this, but it's important to call out that you don't just want to diversify across industry, but also by location and country. Now, I believe in the US economy, so I definitely have most of my money invested in the US stock market, but I definitely have some invested in the international stock market as well, which just helps reduce some risk if something were to happen specifically to the US economy. And overall, it's just good to have your eggs in a lot of different baskets because if one of those baskets goes down, you won't go down with it. But that's gonna do it for this video. Overall, I hope you found this video helpful and I hope it eased your mind when it comes to recessions and bear markets. It is gonna come eventually, but again, it's part of the normal cycle and it doesn't mean you need to panic. And there's things that you can do to lower your risk in these events. So if you like this video, make sure you subscribe to the channel, make sure you hit that like button, leave a comment down below. I want to hear about your thoughts on the video. Did you disagree with anything? Let's discuss it and we'll see you in the next one. Thanks.